Hey, good morning, everyone. Marty Missouri here, May 9th, 2022, Monday. Folks, just stepping in with just a super quick look at the markets with you. Stocks are selling off, notably once again this morning. And of course, I'm thinking about clients, especially when I do this. And those of you who read the blog each day caught last week's note that I titled Pondering. It was during a very volatile day, of course, just thinking about markets as we always do, but also thinking about clients and the handful who, as I put it in that blog post, wear the market emotion on their sleeves. Now, that is not meant to be a criticism. I want to be clear about that. That's just reality. And of course, it's just human reality, particularly if you're new to investing or new to markets, or maybe at a stage in life where you're now paying attention more to the market. And certainly the technology today and the media allows you to pay attention to markets like at no other time in history. So I do know that some people have lived through incredibly volatile periods without ever even really paying much attention to it. Partly because maybe they were younger and they weren't worried about it, but also because just not really having access to the minute by minute movement in the market. And as my co-CIO slash oldest son, Nick, likes to point out, that sort of attention has to add to volatility. And I don't disagree with that. I think there's something to that, although we have had some crazy periods of volatility even before we had all this technology. So, folks, what I want to do just real quickly, just in a couple of minutes, is just remind you that we've been pointing to this kind of action for quite some time now. Remember the bear flag that was developing on the weekly S&P 500 index, and then it points right to about 4,000 on the S&P, and we're trading at 4,024 as I speak right now. So essentially that's playing out. This morning I just threw out a note, and this is not to make anybody feel hopeful or feel better. It makes a lot of sense to me that after 5 weeks for the S&P, 6 weeks for the Dow, that we get a pop in here. Markets are what we call oversold by some technical metrics. You got the CPI coming out Wednesday. And looking at year-over-year base effects, we could see somewhat of a softer print in terms of year-over-year change. And that could inspire some money to rush into this market. We've seen these huge, as I like to say, rip your face off rallies on certain days. Also, Fed governors, several of them, you could tell last week in some public commentary, are really feeling nervous about what's going on in equity markets. Keep in mind that this team has done nothing but support the stock market and been happy to do it up until recently. Now, inflation, which we think was coming anyway on a long-term structural basis, got exacerbated by everything that we know about the last 2 or 3 years. And as I said in this morning's note, they really can't have it both ways. You're not going to be able to go hard against inflation and continue to keep asset prices buoyed. Ironically, however, asset prices falling actually help you or help them in their task to tighten financial conditions. Lots of people have a lot of money in stocks. They'll get rattled by this and they may pull in, and that would quell demand, which is about all the Fed can do with hiking interest rates, etc. And so that does part of their job for them. So if they're smart, they wouldn't want to protect or rescue the stock market right here. But again, human nature being what it is, you can sense that they're feeling a bit dovish, and there was a dovish tilt relative to expectations in Jerome Powell's press conference last week, leading to like a 900-point rally in the Dow that day, which was quickly faded the next day. So folks, my whole point this morning, and I'll just close here, is, we've been pointing to technical trends that, and the same thing on the monthly chart, that have us going down, say another 12, 13% from here. And again, over and over again, I said our base case as that the market explores lower lows during the course of 22 than what we were seeing and what we're still seeing right now. Does that mean we won't see any downside hit to our portfolios? Of course not. We are prepared in a sense that we are constantly managing hedges using options to mitigate, the big ginormous types of hits that markets can go through. We absolutely will decline with corrections. The good stuff we own, the stuff that we have real long-term conviction in, that we don't want to try to get fancy and time the market around, those things will, of course, suffer. with general market sell-offs. The best we can do is be in the areas that make the most sense long term. And as long as that remains the case, live through the volatility that comes and goes. And when we see risk of something substantial to the downside growing, then hedge to mitigate as much of that as we can. We will see drawdowns in our portfolios, but the idea is to not see the entire drawdown in a big major sell-off, which we effectively were able to do when the COVID sell-off happened in 2020. So it's that, and it's being in a good position to begin scaling in and taking advantage of really cheap prices when we start hitting those levels that make sense to us, that tell us that, a bottom is forming, and there's certain patterns that form then as well. That's not happening right now. Right now, lots of volatility. I'll say it again. Won't surprise me if we get what I would call a noteworthy oversold bounce this week. I can see some potential catalysts. But if that CPI number comes in hotter than expected, well, then it's just going to get worse before it gets better. So folks, again, just wanted to stop in, remind you that this is not the least bit inconsistent with what we've been talking about all year. Remind your clients that yes, drawdowns, if you're going to be in the market, if you're going to try to make above inflation rate of returns long term, you're going to have to suffer drawdowns from time to time. Key is to be in the market if you're comfortable being in the market. Yeah, some discomfort is normal, certainly when we get this kind of volatility. But if it's palpable, well, of course, then we have to have a different conversation about what's right for you as an investor going forward. Folks, thank you as always for watching and listening. I'll be back soon. Take care. Bye-bye.